Hello everyone, hope you are doing very well today. This is the second lecture in financial analysis lecture series. I hope you had enjoyed previous lecture. We discussed about role of analyst, what do we mean by financial analysis, what is the difference between speculation analysis, trading, um, how these speculation and analysis these two meet together at some point or overlaps. What elements do we want to consider doing analysis? What are the different roadblocks, bottlenecks which an analyst faces, and so forth. So we discussed all those things in previous lecture. If you haven't watched that lecture, I would recommend you to go and watch the previous lecture. In this lecture, we would be discussing about qualitative and quantitative factors. So let's say, before going forward, let's say what are the fundamental elements uh, of an analysis. There are four fundamental elements. The security, it means that the company or the business what for which you are doing analysis. Then the second one is the price as evident from the name itself, that okay, stock is trading at this price, do we really want to buy at this price, or you are doing analysis for that particular security, considering having in mind that particular price it is traded right now. The time becomes important factor in analysis. Say for example, you are doing analysis before the earnings call and you are doing analysis after the earnings call. So your analysis or your judgment may be different before the earnings and after the earnings. What if that you find the company before the earnings announcement, oh, it's good at that price, but after they announce the earnings, you may change your mind, because it might happen that the company is doing poorly, and you really do not want to hold on to that company for a long time, or you just want to get out of that investment. This is important factor. And the fourth important element is the person. By the person, what we mean here, the individual. What are the qualifications, what experience, what insight an individual has who is doing the analysis, or and the analyst's analyst's qualities, analyst's qualification, analyst's experience. I would put more emphasis on inherent qualities and experience rather than qualifications. There are so many CFAs out there, but they don't know much about investments. So let's put more emphasis on experience and the inherent qualities. Some analysts may be aggressive, some may be not aggressive. It's, just like to take things slow and very conservative. In other words, a simple word, SPTI, it's easy to remember, isn't it? Always remember this word, SPTI. Or in other words, we can say, or we can ask ourselves a question before doing analysis. Should this security S to be bought or sold or retained at this price P at this time T by this individual I? Isn't it interesting? Think about it. Now let's say what we mean by qualitative and quantitative factors. So let's talk about first quantitative factors. So quantitative factors put more emphasis on statistical elements in analysis, mathematics, numbers. For example, let's say what are the earnings, what are the dividends, how much is the profit, loss, how much is the cash flow, what is the market capitalization of the company, how much liabilities company has, and what are the assets, what are the different ratios, financial ratios, and other operating statistics. For example, what is the management turnaround ratio or management effectiveness ratios, and so forth. So quantitative factors in general deals with the mathematics of the company's performance, or we can put a number. It deals with the numbers in simple sense. Now let's talk about qualitative. Quantitative factors are important as well as qualitative factors. So always remember that. In the qualitative factors, we mean here what is the nature of the business, whether the company is selling the potatoes or the company is manufacturing cars. So nature of the business, or the company is producing or manufacturing chocolates. Second one would be like where the company is located, so physical, geographical and operating characteristics. In which countries company operates, where is the headquarter of the company. This becomes very important, especially if the company is doing businesses in many countries. So company may suffer due to up and down in the currencies. So currency fluctuation, that becomes very important to take into account as well. That's going to directly impact company's profit and loss or net income. Also, what are the geopolitical situation in those countries where company is operating? So all those becomes important factor. For example, recently, say Qualcomm, it's a big company in semiconductor area. They suffered a lot in China because of government policies, anti-monopoly laws, and so forth. So company kind of is going down at this point in time. So think about the nature of the business and so forth. You can put a mathematical number onto that, but different factors, market news, which becomes very important. Third important factor here for the qualitative is the character of the management. That is very important. Put more emphasis here. Say a very simple analogy. If the character of the management is not good, does it make sense to invest in that company? Or in other words, think about you lent some money to your friend and your friend promised that he will return back. But when you asked money, your friend did not return back your money. So what does it mean? It means that the character of the person is not honest. So do you really trust that person anymore? You would not, if you are a wise man, you would not lend money again to the same person. Think about this. This becomes very important, the character of the person who is running the business or the management of the board of directors, how they are making decisions. The company is nothing but run by people. So if the people are dishonest, it's not a good idea to invest in that company. So there are different, different kind of things you can poke around here and there and can really find a sense of the company's management or where the company is heading. Fourth important factor is outlook for the business or the unit. What are the industry trend in which the business or this company is operating? What's going to be in the next 5 to 10 years, where the business is going to go in that particular area? That becomes also an important qualitative factor. But all those qualitative factors, I would say that the character of the management and nature of the business is very important. Let's talk about future earning trends. So if you find that you want to buy this security or this company's stock, what is the trend in earnings? And based on that past trend, can you predict the future earning trend? And if you predict the future earning trend, whether the company is able to perform as per your expectation, you can observe in quarterly results. Always remember, as an analyst, you are mainly concerned with the values which are supported by facts and not with the expectations. This is important because if you are dwelling more onto expectations, and your decision is not based on facts and figures, it might land into territory of speculation. And we discussed speculation in previous lecture. If you haven't watched my previous lecture, I would recommend you to watch the previous lecture. So always remember, analysis is mainly concerned with the values which are supported by the facts, not with expectations. Another important factor here is the inherent stability, which becomes one of the major qualitative factor. What do we mean by inherent stability? It means that in simple terms, whether this company is a business or is stable or not, or the company, for example, if the company is manufacturing chocolates and another company is manufacturing cars, think about which one will be more stable. An analyst's conclusion must always rest upon figures and established tests and standards. Always remember this thing, that you must, as an analyst, you must apply all sorts of financial analysis principles before recommending some company to buy or hold or sell. They might be like we kind of separate it into regimes, qualitative and quantitative. So one must have to apply both or think in both terms, and check the balance sheets, check the cash flow statements, check the income statements, and see what trend company is following. There are different factors we will discuss in coming lectures. Now let's talk about more about inherent stability. That becomes one of the important factors. As an analyst, you must penetrate beyond the numbers and really consider the inherent character of the business. Let's say two companies. Company X, it's a chain of grocery store. Company Y, it's a motorbike manufacturer. And their dividend cover for year 2000, 2011, 12, 13, 14 is given in this table. This is a hypothetical example, but it is evident from the numbers that which one looks like attractive based on numbers. You may say motorbike manufacturer, but no, not really. Think about the business, the chain of grocery stores. See, people gonna buy food every day. That becomes a important necessity. But people may not be interested in buying motorbike all the time. So think from that perspective. What do you think now? It changes your mind? Yeah, the chain of grocery store has more inherent stability. If market goes down, people are not gonna stop food. People will always go to grocery store, buy food, but people may not buy motorbike. So which one is more stable now? Think about it, X or Y? I would say X is more stable. X has more inherent stability. I hope you have enjoyed this lecture. If you have questions, comments, or anything, you may send an email or a message. And do not forget to subscribe LEPROFESSEUR YouTube channel. And thank you for subscribing LEPROFESSEUR channel. I hope to see you again for the next lecture. If you have questions, if you want to arrange private lessons or tuitions, you may send me an email at hr@leprofesseur.org. Thank you. Have a wonderful day.